The broadcast is now starting. All attendees are in listen-only mode.
Right, can you see my screen?
Yes, I see that the webinar is already started, so you can continue.
Okay, perfect. I didn't. Sorry about the confusion. All right.
No problem. Have a good one.
Thank you. All right. So today we will be talking about the Volatility Valuation Index. So this is a new tool that I have created. Actually, it's not new. It's I've been using for some years. Two in terms of I'll be making it publicly available in a very short while. So the presentation today will focus on a tool to, as the name implies, to evaluate volatility. And first of all, I will show the conventional tools for evaluating volatility, such as basically average to range. I could also focus on standard deviation, but on this particular webinar, I'll be just focusing on ATR. Then I'll be showing the volatility valuation. Then I'll go into to show you what the issues are with the average to range calculation. Then I will go into the volatility valuation index, my own proprietary indicator for gauging if volatility is too high or too low. And right at the end, then I'll be opening up the trading view, and hopefully we'll be do some live analysis on charts, either seeing the volatility valuation index. I'll let you pick a market of your choice that you really like, and then we can also go into see what trades I'll be coming up for this week. So okay, let's begin. First of all, the risk warning. The risk warning basically is that there is a high degree of risk involved in trading. Past results are not indicative of future returns. S.M.A.R.T Trading Systems Limited and all individuals affiliated, including me, assume no responsibilities for your trading and your investment results. I do not make any kind of guarantees during presentations except one, that you will have losses in trading. And with that out of the way, let's start. Okay, this is how usually my presentations end. So in order to avoid that, I'll try to keep you awake, and I'll give you some attendance bonuses. And the attendance bonuses actually will be, first of all, an awarded paper I wrote in 2022 called MACTV Volatility Normalized Momentum. It's an indicator I designed in 2014, decided to publicly disclose in 2022. So I thought, okay, I'll write a paper about it, send it off to two major professional bodies, the CMT Association, which is the largest technical association globally, and the National Association of Active Investment Managers. They both hold annual research awards competitions. And during this paper, I submitted to both organizations, and it won first prize for both. Then I will also send you the MACTV indicator again on TradingView. It's already on stock charts, MetaStock, and soon on other platforms as well. And also I'll be holding a MACTV Momentum Model webinar as well. So all you have to do is just send me an email, alex@alexspirgle.com. Provided, of course, you stay awake. And another thing is I'm also launching a trading community, which is more of like in the form of more of a private trading group. Membership will be capped at 50 people. So send me information if you like to get on board that, because I'll be giving some free courses. All right, let's begin. Context before content. So in order for someone to learn rules-based trading, I've created a template, a roadmap to do that. But before going into the roadmap, I want to show you basically my philosophy and where I'm coming from in terms of my trading approach. And that's what I call MTMF, multiple time frames, multiple factors. I believe that there are 3 operating time frames, which I use basically. It's the daily, the weekly, and the monthly chart, hence multiple time frame. And there are also multiple factors because I believe that there are different factors, return drivers affecting each time frame. So for example, if you are on the monthly chart, I look at the business cycle and the economic statistics. I think these are the dominant factor. Then I go to the weekly chart, which is usually macro factors such as commitment of trader report, sentiment, seasonals, and so forth. And then go to the daily chart to do my technical analysis. I don't because this is the part will show me what the market is actually doing. First of all, I'm interested to see what the market, what the forces taking markets from point A to B are dictating, and then what the market itself is doing. And finally, then take the trade using the Forest framework, which we'll see later on. So again, this is my framework for strategies. How I can go from being all over the place, completely scattered, to being completely systematic. And this is the roadmap to rules-based trading. First of all, as I mentioned, look at the macros, which answer the question why. Then, whoops, got trigger happy. Then I look at the markets, technicals, because macros answer the question why. Markets technical analysis answers the question when. So I use both tools, but for different reasons. And then I go into a model, the mechanics basically of a trade, which is the how answers the question how do I get in. And this is how it looks like in more detail. Basically, it's a decision support system. And again, first of all, intermarkets, then I go to commitment of trader report, sentiment and seasonals right at the bottom. So these are my setups. Each of these can be on its own a reason to take a trade. So first of all, go to the weekly chart to see the macros. And I need at least one, preferably two, to be pointing in the same direction to give me a macro directional bias. Then I go to the technicals, the market map, trend structure, basically, relative ranker, MACD, volatility valuation index. And this is what we will be talking about today. And I'm mentioning this because it's important to have context before content, in the sense that yes, volatility valuation index and the MACD, of course, which I mentioned previously, are extremely important. This is what I call one of the core 4 of technical analysis. It's basically going back to first principles. But it's not the be all and all. I mean, there are other aspects that you can see markets from and confirm what is going on from various approaches. So this will be talking about volatility valuation index. Again, it's good to have a big picture where we are. Then I go into the mechanics of a strategy, which is the Forest framework, setup, signals, stop, and size. So volatility valuation. Let's talk about a little bit about theory. Right. So let's try to understand what volatility is, other than the proverbial that is just fluctuation, and what is important. Now we see two stocks here. One is denoted with the black line, and one is with blue line. Supposedly they both end up going from January to December. The ending price for both is the same, $100, but you can see they have taken completely different paths. The blue one is much more volatile, and the other one is less volatile. So that's the difference. Although from a price appreciation point of view, they're exactly the same. From the return point of view, but they have all completely different paths. So if you put it in an analogy, if we say that the trend is basically direction, momentum is speed, relative strength is distance, i.e. the odometer, volatility is basically how bumpy the road is. And it can be used for many parts of trading. So let's see, first of all, you can use it as a setup. Volatility can be used as a setup, and I'll show you in this webinar how to use it as a setup. Of course, needless to say, I've also used it to normalize momentum in the MACDV formula. You can also use it as a stop, and I mean, as a function of average through ranges, you can say, I'll be placing my stop that far away, and you can also use it for signal generation and also for size. And you can also use it for your trading size to your position size volatility normalized. So volatility is not just for saying if the market is overextended, but you can use it in other aspects of trading as well. Very, very useful. Okay, so let's see a bit of the tools now. As I mentioned, we'll be seeing a bit of the tools, the basic tools that I'll be showing you mine, and then we go into techniques, and also we can see some examples. So what I would appreciate is if you start sending questions when I write at the end of the webinar, so we can see the volatility valuation indicator on your favorite market, and then we can also do some basic analysis outside of the volatility valuation index in the sense of what I'll be which markets I'm looking at right now. Okay, so part one, let's begin with the concept of true range. What is true range, and how does it differ from range, basically? So range versus true range. Now okay, now we have a bar, and these are the open, high, low, close. Low is at 90, high is at 100. So I would like all of you to write in the chat box, please, what is the range for this bar? Feel free to write your answers. What is the range of this bar? Yep, the answer is 10, is 100 minus 90. So we have now this bar, which has this particular specifics. The low is 102 and the high is 110. So what is the range for this bar? If we equate range with volatility, the intraday range, the intra-bar range. Okay, so people say the range is 8 because 110 minus 102, that's 8. Well, I'm not sure if this is quite right, and let me show you why. Because if you notice that on the first bar, the close was at 98. The high, the next bar, was at 102. So which means there was, as soon as the market closed at 98, the next day opened at 104, had a low of 102, and had a high of 110. But there is a gap between the previous bar's close and the next bar's low. So imagine being long, hopefully, this market, let's say it can be a share at say $98, and you had 1,000 shares, so $98,000 by the close of the first bar. Next bar, when it gapped up and had the low at 102, basically you didn't pocket just the 8 points difference in dollars difference going from 102 to 110, but also the 4 going from 98 to 102. So the concept of true range is not just the high minus the low, but also with reference to the previous bar's close, because you would be pocketing this difference as well. You wouldn't be saying, okay, from 102 to from 110 to 128, but also the difference between in that gap. So the true range is 110 minus 98. So the true range is 12. And that's a way to calculate the range of the bar, including gaps. The formula for, again from true range. This is a formula by Wallace-Wilder. So this is the formula. You can see the mechanics of it, but you don't, strictly speaking, unless you're really interested in markets. This is all calculated for you by in your technical analysis software. Okay, so let's do some examples and some interpretation. So bar 3, again, this is bar 2 has a gap with reference to bar 3. You can see right at the bottom the average true range. So that was 202 pips. And then the next bar, bar 1 as it's called, going from right to left, it's a small inside bar. So it has 44 ticks as a range, but you can see how the bar 2 was so much larger, not just because of the range, but also because of the gap. And you can see again, we've right at the bottom is the true range. So you can see what is so you can see high bars that have a big range from high to low. You can see how that is depicted with true range, and we can measure basically what's the volatility, the intraday, the intra-bar volatility, intraday volatility for each bar. So that's the concept of true range. So what is average to range? Well, basically average to range is, well, true range basically answers the question is what is the volatility per day? So what was yesterday's volatility, or the day before that, or the day before that, in terms of ticks or pips or whatever unit of measurement you have for each market. And then you average through range. Well, basically answers the question, what is the volatility not for one particular day, but for a period of time? And the formula to do that, that's very very simple. We go average through range, which is through range 1, basically yesterday's bar, the day before that, the day before that. You take 10 different bars, divide by 10, and you find the average. So basically this answers the question, what is the average volatility for the past 10 bars? Now, please keep in mind, again, this is an average. The first true range average, how much is the volatility in one particular bar? This answers the question of what has been over a range, but this is in ticks, pips. It's an absolute price indicator. Again, this is how it looks like. Again, this is EuroFX. Top chart, middle chart is have the average true range. Sorry, a true range, when you can see on each bar what was the intra-bar volatility. And then you can have average true range, which is 74 ticks for the euro. Well, it's 44 for the previous bar. So the previous bar had the 44 tick range, and 74 is for the past 10 bars. So this is what you can see with true range and average true range. So let's try to compare apples to apples instead of apples to oranges, because that's sorry, first of all, let me show you why we're comparing apples to oranges and then try to compare apples to apples. And I'm saying this because I'm sure you remember that average true range, as I mentioned, is an absolute price indicator measured in ticks, pips, whatever, or dollars or pounds. For example, if you have shares listed on European exchange, it will be based in cents per euro. If it's in a US stock exchange, it will be mentioned in cents per dollar. If it is in British stock exchange, it will be pennies and pounds. So if you have futures, it will be in ticks or in pips if you're a forex guy or girl. So again, you can see that the units of measurement are not uniform. So how can you compare everything together? So again, this is a chart that shows exactly what I mean. So EuroFX, 74 ticks, average to range. The Dow Jones Industrial Average, 159. Again, doesn't mean that the Dow Jones has 2 times the volatility of euro, it just shows you that because it's an absolute price indicator, it will be a function of the absolute price of the market we are calculating it. So that's always something to keep in mind. So that's the average to range, and that equation of its limitation. Let's go to see the normalized average true range. The normalized average true range indicator, what it does, basically goes to try to alleviate, if you will, the problem that the average true range indicator has, and by trying to normalize the value, so it can be comparable across markets. So this is the ATR normalized. So how do we normalize so we can be comparing it across markets? Again, I could take average true range, for example, N, denoting how many bars we want to be seeing, divided by the close of the market and multiplied by 100. So what do we do then? Well, if, as I mentioned, average to range, it gives an absolute price indicator, so it measures in ticks and pips. But what we do is we take this value and divide it by the price of the underlying market, so we can put in context, in percentage terms, this number of absolute price of fluctuation. So for example, as we saw previously, the number of 74 ticks for the euro, we place that in context of the price of the euro, and the 159, if memory serves, we saw for Dow, we will place that in context of the absolute price of Dow. So for example, let's say a market that is at 10,000 points, it's very different volatility reading to have 150 points fluctuation than a market that has, it's a 5,000 point market. Again, it has a 150 point fluctuation, and 1,000 point market that has a 150 points fluctuation. So again, we divide it by the close of the market, multiply it by 100 to put it in percentage terms. So this is how it looks like. Again, the same EuroFX chart we saw. So, so the 74 ticks divided by the price of the average true range, and lo and behold, it becomes a percentage. Now it's 0.7%. And that's interesting because now it becomes 0.7%. So now we start seeing in terms of percentages. So if someone asks you what has been the average volatility for EuroFX for the past 10 bars, you'll say it's 0.7%. Again, this has a lot of implications in terms of position sizing, stop placement. But if you want to, for example, you can have a rough place to put your stop. It definitely has to be put more than 0.7%, because this number tells you that for the past 10 bars, this is how much the euro fluctuates in general. So if you have any stop that is less than that, there is a good chance that you may be stopped out, and that's one of the reasons I don't like fixed stop 10 pips, 10 ticks. Again, this is the same chart we saw previously with the Dow Jones. The normalized average true range is 0.79%. The average true range is 159, which we saw previously. So 159, 0.79. Now you suddenly have it in percentage. So it's not that far. So you can see 0.70 was the volatility for the euro, and 0.79 for the Dow Jones Industrials. The absolute number was twice as big, but they are almost the same now. Again, same thing here. We have the Dow Jones Transportation average true range in percentage, and then average true range in absolute price. So in absolute ticks, it's 23, but if you put it in percentage, it's 1.44. So let's look at some techniques. Let's look at some techniques, and because this is the trend volatility now. So the question we've answered so far is what is volatility for, what is the volatility for the past X bars, so 10 bars, because you can adapt that number. It can be 5 bars, it can be 10 bars, but it doesn't answer the question. So we put in percentage, but it doesn't answer the question, is it increasing or is it decreasing? Because it's much different to have a, say, volatility of, say, 3%, and it's coming off of a reading of 2%. So basically volatility is increasing. And that scenario is completely different to be in a volatility environment when you have, again, 3% volatility, but it's coming off of a 5% volatility reading, which means that volatility is decreasing. So how do you see the trend of volatility? Is it increasing or decreasing? So again, what we can do here, we can create some kind of a function that measures the trendiness, the trend of the volatility. And what I have done here, again, this is the average through the normalized average through range indicator. And what I have done here is basically create some kind of a trending function on the indicator itself and color coded it so it can be telling you, answering the question if it's volatility is increasing or volatility is decreasing. So in green, it means that volatility is increasing, and when it is falling, volatility is decreasing. So this is how it looks like. Again, so with one simple tool, you can just see if volatility is increasing or decreasing. Again, same thing here. This is for Bitcoin futures, and here you can see the same chart, whether is volatility is increasing or decreasing, again based on not just on a percentage basis, but also on if it is normalized and also increasing and decreasing. So we've seen the trend volatility, and let's go to the real breakthrough. And this is my input for the volatility valuation index. So the trend for the trend of volatility, as we mentioned before. So this is the chart. Let's go back to the previous chart. Volatility trend here will answer the question if increasing or if it's decreasing, but it will not answer the question if it is high or low. And this was always my problem. How do we have volatility speak to us, for example, and know if it is high or if it is low? I mean, is it an extreme? Because the volatility at extremes has a a lot of informational value. And this is why I created the volatility valuation index. So where did this indicator come from? The inspiration. All right, so let's go back to 2010. The second gentleman from the left is Mr. John Bollinger, and this is a meeting we had, went for beers, along with my good friend Trevor Neal at the left and Ken Tower at the right. That's a meeting we had in 2010, so I'm looking much younger then. So we had a meeting in London, went for beers. Actually, that was the very meeting that John Bollinger asked me to look into chairing the chapter for the UK chapter of the Chartered Market Technicians Association. So during that meeting, other than that particular discussion, we also talked about markets. And one thing that John mentioned to me, and it stuck with me, was that low volatility is where trends are born. High volatility is where they go to die. And I thought that's really interesting. First of all, at a concept basis, that low volatility is where markets are born, where the trends basically are born, and high volatility is where they go to die, basically where they finish, trends were finished. So it became like an obsession of mine to measure, to quantify what constitutes low and high, because that way I could, see where trends are born and where they die. Again, that was a difficult task, but I created basically an indicator that shows you when volatility is high or low, because this is one of the problems, as I mentioned before, we didn't have with the normalized average true range. You can see when it's going up, increasing or decreasing, but you don't know if that increasing is a high or low. So I created another volatility valuation index, and this volatility valuation index at 1.3, 1.4 is when volatility is high, and around 0.6 to 0.7 is when volatility is low. So that was the extremely high and extremely low. So that helped me through this indicator to see if it is the volatility is at an extreme. This is the volatility valuation index. This is how it looked like at its raw format, basically. So these were the extremes. When I started playing around this with a particular market, and what I found was that this model, actually this indicator, worked wonderfully across markets. So around 1.3 was the benchmark for extremely high, and 0.6 was extremely low. So let's look at how we can use this index. First of all, volatility is a setup, okay? It's not a signal. That's the first thing to remember, because I'll be showing you a lot of examples, which means sometimes it can work very, very well, but sometimes it can be giving you, yes, it can give you warning, but it can warn you, volatility can be at a high level for a prolonged period of time. So its market timing value is watered down. But it's an excellent setup. It is focuses your attention in the sense of, this is a market to be paying close attention to. And this is the time to bring in the timing tools and guns. So the first tool is indicator extreme values, trend change or trend reversal. What is the difference between trend change and trend reversal? Supposing a market that is rising and you get an extreme, there are two things that can happen there. Either the market can reverse, from going up to go down, or it can change. What is the difference between a reversal and a change? A change basically is a market that can go from up to sideways. The trend changes from up to sideways, but it doesn't necessarily reverse from up to down. So both things can take. So in the former scenario, there is a correction, if you will, but it's a correction in time, not in price. So basically you create a trading range. Second, indicator highs are usually at bottoms, especially for equities, and indicator lows are usually at top. But I say not always, because by and large, volatility is trend agnostic. This is a bit of a simplification to say that indicator highs, the volatility at highs are usually at bottoms. Yeah, because bottoms are a bit more emotional events. Fear is a much stronger sentiment than greed. But if you study markets long enough, you'll find that for equity markets, this is definitely true. But for commodities markets, it's actually the opposite. Market highs are high volatility events and market lows are low volatility events. So again, although there are some generalizations, always check the chart. And three, indicators are setups. Again, it's not a signal. So it can be a part of the part of your repertoire of things to help you check a market as a setup, as a potential candidate for a trade. So let's look at this a bit more detail. This is a chart of gold, and right at the bottom is the volatility valuation index. Again, levels of 1.3, 1.4. The indicator is telling you that the market is at an extremely high, where trends are high, and very low where trends are born. So let's look at some examples. Again, when the trend, the volatility is high, this is when usually bottoms, we have bottoms, at least in this particular chart, in this market in gold. So again, the market changes. So if it's falling to an extreme volatility, reading, then you should be looking for it to start going back up. But we will see examples with the opposite is reversed, because in earnest it is a trend agnostic indicator. But it's just that there is a slight tendency for market bottoms to be forming. Again, another market going from commodities to FX, and as I mentioned later on, we can see any market of your own choice. So British pound, again at the high, extreme volatility. We have volatility, very market bottoms at these volatility highs, extreme volatility the readings. This is a chart of the S&P 500. Again, volatility valuation index upon 1.3. You can see that the indicator is usually in going from left to right. You can see that was the COVID low. How you had it as a setup to start looking for a potential reversal. Then going to September 2020, again the bottom was called by the volatility valuation index, and then in November 2020 we had a short-term top, and then the market went sideways. February 2021 short-term bottom, March 2021 short-term bottom, May 2021 short-term bottom, October 2021 short-term bottom. Again, all these called with the volatility valuation index. Again, notice that these are setups, these are not signals, but they are very, very useful. Again, 2020, 2022, again, bottoms, for example, October 2021, we saw previously right in the middle part of the chart, a volatility valuation index above 1.3, the market is bottoming out. December 2021, again, market bottom. January 2022, market bottom. May 2021, 22, bottom, and so on and so forth. So as you can see, high volatility readings is where the trends go to die. Again, 23 to 24, again, when there are low volatility readings or high volatility readings, again, October 2022 at the bottom, November 2023 for the top, again, April 15, 2024, the bottom, August 2024, August 5 is the bottom for the market. Right, Bitcoin futures, January 2021, May 2021. You can see it's working across all markets. The indicator, we saw FX, we saw commodities, we saw equities, and now we see Bitcoin, cryptocurrencies. So the indicator is working across all markets. It is a distinct advantage over indicators, for example, like the VIX, because the VIX is, just a side note, I ran a correlation number between the volatility valuation index and VIX, and it was very high, probably around 90%. But the advantage is that the VVI has over VIX is the VVI can be used across all asset classes, not just the S&P 500. It can be used across all time frames, not just the daily time frame, which is the VIX is, and I guess it can be used across all asset classes, not for S&P 500. So again, this is the chart now of Bitcoin at a later stage, 2020 to 2024. Please do note, for example, March 2025, high volatility valuation index, it went with the top. January 2024 again with the top. October 2023 again with the top. So we do check the chart in terms of, again, same thing with gold futures. So it is an extremely valuable indicator that shows you extremes in volatility and in markets. So, and it's also not correlated with momentum indicators, because sometimes it goes with top, sometimes it goes with bottoms. While momentum indicators, when a top by definition will be overbought, when it's a bottom will be oversold, but this can go both ways. So you're looking at something that is uncorrelated to, because a classic mistake I see with people is they have a chart and then on top of it they plot say the RSI, the MACD, the stochastic indicator, Williams percent R, the percent B, and all, so many different momentum indicators, which is one of the classic rookie mistakes that people do. So recap. True range is about what is the fluctuation for 1 day in terms of ticks, pips, and individual cents or dollars. Average to range, it shows you this over a period of time. Average to range normalized puts this in perspective of as a percentage fluctuation. And then you have the superior tool, if you want, the volatility valuation index, because it shows you if volatility is high or volatility is low. So it certainly does evaluate it. Again, these are the attendance bonuses for those that manage to stay awake. All you have to do is send me an email at alex@alexspiroglu.com. And what I would like to do now is perhaps if you want to send me your favorite market so we can see the volatility valuation index in live. So let me go from this to this. There you go. I think you can see my screen. Right, so this is gold futures. And what we have here, again, this is in trading view. This is this is gold futures. Again, what we're seeing here is the average through range in ticks. So at the bottom, the average through range here was around 89 ticks. So since the average through range in percentage was 2.7%, and this is the average through range percentage, which goes to show you if the trend is increasing or decreasing. And this is how the volatility valuation indicator behaves. Again, right, so this is the extra informational value it has, because this area, when the volatility valuation indicator indicated that the volatility was high, we did not see this through either of these indicators. Well, sorry, no, it was just high, it was an extreme. Same thing here, it was an extreme. But we did not see this in both the average, the normalized, or the plain average to range. So let me close this and put this in percentage. Again, it was very high, but it was telling me if the valuation is, only you can see it with the benefit of hindsight. So let me close that as well. So this is the volatility valuation. And so we can take it as far back as you want. Again, high volatility valuation, the VVI is high, market is at a low. High volatility here, market is an extreme. High volatility here, it's an extreme. Again, high volatility is at an extreme. This is a really, really interesting indicator to use in conjunction with your other repertoire. And other things I'm using it with is in particular the MACD, the volatility normalized momentum. So let me wait for the indicator to load up. So as I mentioned, I use it in conjunction. What I try to find to see is tops and bottoms where both indicators at an extreme. So at this particular junction point, the MACD was at an extreme. Not here, it wasn't indicated by the VVI. This point, the market was at the volatility was at an extreme, but it wasn't overbought. So again, you can see the one of the benefits is that you can locate extremes not indicated by other techniques. Again, Here, volatility was at an extreme. The market went sideways. It had a correction. So basically, it had a correction in time, a trend change. That wasn't indicated here by momentum. Likewise here, now both indicators, both the VVI and momentum were at an extreme. So you can see how gold futures topped in April 24, and then it didn't start rallying up until July 24. Likewise here, the volatility valuation indicator at an extreme, market went sideways for a bit. This wasn't indicated by the momentum. Now this is really interesting. Now volatility valuation here at this particular point was at an extreme, at extremely high level, or the MACD was also at a low. So you had two pieces of information, both high volatility and high and momentum to the downside, indicating that this might be a potential top. Likewise here, you had an extreme in momentum over 156 on the MACD indicator, also in volatility, and you can see how the gold topped around this area. Now let's fine tune into this. If you want to be doing this real time, if you will, at this point here around the 3rd of April, this is when the volatility valuation indicator started telling you that volatility is a bit too frothy. So it remained high through all this period up until it started falling here. So all this was a high and extreme volatility period. The MACD indicated that it was at an extreme at this point here. But from a volatility point of view, you see that there was a range, especially in very high volatility areas. You can see that there's more like a range of time and prices when it becomes at an extreme. So we need to, as I mentioned, we need to use this as a setup, an excellent setup tool. Sometimes works as a timing tool, but usually it works as a setup tool. All right, so I have a request to see the OMXS. I don't already have that. Let's see. Thing OMXS Sweden cash. MX30 Stockholm 30 index. I haven't looked at this S.M.A.R.T to tell you the truth before, so I would assume that's the one you're seeing, you're referring to. Again, another good example here, volatility extreme, MACD also forming a low, being at a very low, saying oversold momentum, bottom. Again here, we had the volatility valuation indicator, also extreme. We also saw the bottom here. Extreme volatility here from the top, extreme volatility here, and then also with the MACD at the bottom. So you can see at this point, you had two pieces of information. So the indicator, both of them now came extreme. So both volatility and the MACD on the 3rd of April 2025. So at this point here, so there were a few days of decline as well, so quite substantial. So as you're checking charts, you might think, oh, that was a significant, but actually it was, because the volatility became extreme at this point when the close was around 2,478 points. The MACD became here, so both were at the close of 2,385 points. So the bottom wasn't at here at 2,179 points. So as you can see, there was a bit of more panic 3 or 4 days. So that's why I use it as an setup tool, as a signal generation tool. And by and large, this is how it works. Again, let me see another volatility. There you go. Another volatility valuation extreme here at the bottom. Another volatility valuation extreme with the MACD here at the bottom. Volatility valuation and the MACD here at the bottom. Volatility valuation here and the MACD here at the bottom. Again, MACD and volatility valuation. So, but the beautiful thing is that you can see these are not correlated. So one is high, the other one is low. Of course, sometimes it can be both are high, because as I mentioned, volatility is trend agnostic, but by and large, in this particular case, special equities, they go on opposite. So you're not using two similar indicators, RSI, stochastics, to confirm the market. So, which I think is a very, very big mistake. So this is how it looks like with the volatility valuation indicator. Again, feel free to send me questions. Let me see. So if you have any questions, either you can send me an email or you can contact me, so I can let you into the give you a glimpse of how the community going. Again, I would like to thank you very much for your attendance in this webinar. And all right, so I had another chat. I'll answer that privately. So thank you so much for your attendance, and also the webinars organized by investing.com. End of month we'll be having our last one. So with that, I would like to thank you all so much for this. Send me your email address. Right, yeah, so the request is send me your email address. My address is right on the chart, so let me write it as well. Again, I would like to thank you so much all for your thank you so much for your attendance. I hope I'll be seeing you, and always keep volatility as part of your repertoire.